let's keep the pace going. I would like to quickly introduce our next panelists. The first one is Ophelia Snyder, the founder of 21 Shares. Who has never heard of 21 Shares in the crowd? See? All of them. Doing great on the branding side, Ophelia. I asked her, why did you build 21 Shares? And she said, my mother got me into crypto, so I wanted to build a product that our parents could use. And I was like, yeah, I like that, right? So first up is Ophelia Snyder, the founder of 21 Shares. Ophelia, you with us? Might be lost. Next up is Matthew Sigel. He's head of digital asset research at VanEck. He's got a great article written in 2017, I believe, called Google is Evil. You need to share that. Paul, get that circulated. Definitely. Anything with Google is evil, I want to read that, right? Next up on stage, Jason Xavier from Franklin Templeton. And the panel will be moderated by our good friend, Eric. Enjoy. There you go.
Welcome, guys. First of all, anybody have any problems with any of my slides? Any objections? Anything you want to push back on?
I was about to say I loved the boomers don't have we cans bit.
You know what I'm talking about. They're stronger than you think.
They're stronger than you think. They are also, like, there's a velocity of money question. They're not traders.
Yeah.
I think people, like, forget that. A lot of people in crypto today like to trade. They trade vol. It's very, very different than people who are like, set it and forget it. So I loved that slide, personally.
So I think ETFs are essentially bridges. They're bridges from the crypto world to, I won't say the regular world, but the big pie of money and 60-40 investor world. We'll call it the like average investors. This is an easy way for them to get exposure. So Jason, let's start on the end with you. You're on the bridge, and you go on both sides. So I want to get everybody here some insight into what's going on the other side. Clearly, the flows are coming in. Who is buying this so far? What kind of investors are you seeing get interested?
Well, thanks, Eric. Jason Xavier, I look after capital markets in Europe and Asia on the ETF side for Franklin Templeton. I don't know if you guys were here pre-lunch. You saw Jenny Johnson on a panel talking about the transition to a protocol economy. We are a 76-year-old asset manager. People are now realizing that we are one of the most advanced when it comes to utilizing digital technologies. We effectively have built our own digital infrastructure, our own digital ecosystem. We have our own wallet. We are doing node operations on 5 public blockchains across 30 nodes. So we are pretty immersed, okay, right from the top. Who's buying these products? We launched our ETF. We went on to Bloomberg after the first quarter. We looked at HDS, and guess what? Lots of institutional buying. Hedge funds, institutions, state pension funds in the US, looking at their risk-adjusted returns, looking at their portfolio construction, and now realizing 8 of the last 11 years, the best performing asset, we can't ignore this. These are the institutions that are now coming to the table, adding liquidity and really opening this space up.
One thing that I found really striking from the data, those 13 Fs, was that hedge funds bought $5 billion worth of these ETFs, and they manage roughly $5 trillion collectively. Investment advisors bought $2.5 billion, so half the amount that hedge funds bought, and they manage $100 trillion, so 20x. So to me, it's pretty obvious that the more nimble hedge funds were the first buyers, and the registered investment advisors are taking smaller positions, taking their time. And when we look at the numbers in a year, my guess is that the investment advisors are going to outweigh the hedge funds by 5 to 1.
But I think that's also been pretty typical of this market. Over the last 5 years, you've seen a lot of those edgier investors who are more tactical or who are potentially running different kinds of trading strategies being a pretty large part of this market, whereas intermediated flows, things like RIAs, things like private banks, are a bit slower, and certainly anywhere where you're getting discretionary allocations by managers, so someone who's running a, some kind of fund, from what we've seen, have a tendency to be last, with the exception of hedge funds, which are kind of their own thing.
And when we talk about, let's talk about an RIA. Let's say I noticed one RIA was in Kansas, another was in Minnesota. To me, this is the holy grail for you guys because they manage $30 trillion alone, and they're, can be conservative, right? This is a kind of a crazy asset class for a lot of them. Take the Kansas advisor or the Minnesota, on average, what % are they allocating? It's something it's harder to see in the 13F because we don't see their whole portfolio, but are we talking like my chart showed like a 1%, 2% allocation? And could this lead to them getting into more or even like de-ETFing and going into the crypto directly?
It's hard to know exactly the answer to that question. From my experience with talking to institutional investors, they are most comfortable in that 1% to 2% range. But where an increasing amount of the flows are coming are from these model portfolios that are often multi-asset. So on the VanEck side, we manage about $100 billion US. About $2 billion of that is in crypto dedicated strategies, a number of ETNs in Europe, a couple of private liquid token funds in the US. And we also run some of these model portfolios versions on the 60/40 that we call thematic. And in those products, we have roughly 5% weight to Bitcoin, and that's at purchase. So it can go anywhere from kind of 3 to 7. I haven't noticed too many institutional investors taking swings quite that large yet. Although we just released a big report on Ethereum. I hope you guys can all take a look. And we did some quantitative analysis in there to try to figure out what is the ideal BTC to ETH mix. That came out at about 70-30. And then we introduced that crypto portfolio into a standard 60-40 model. And what we found is that for investors who are willing to stomach a pretty high volatility, like a 20% annualized vol, versus the S&P at, say, 10, a crypto allocation of up to 20% continues to improve the risk-adjusted returns. So that 20% target is, quite high, except for the most aggressive investors. But the math, at least if past is prologue, the math justifies it.
One of the interesting things that we've seen is, so we've been distributing these types of products in Europe for far longer than in the US. We're coming up on 6 years of selling crypto ETF structures here, or at least the equivalent in the European market. And one of the things that we've seen with institutional investors, which has been really interesting, and I suspect quite strongly that the US market is going to follow the same pattern, is initially you see hedge funds, you see some RAs, you see initial allocations that look like what I would call a dummy bet. Like, I'm not sure about this, let me throw it in there and see how my clients react. See how they actually feel about a 70 vol product as part of a portfolio. Are they going to be comfortable with that? Is it really 70 vol? How is that going to perform? How are they going to look at these metrics? And then you start to see people build. And from a place of, we've had clients who started with like a couple basis points of Bitcoin who are now doing like really significant positions in a much longer tail of alts than you would expect. And they're extremely institutional in nature. It's just a question of how long that takes. My guess is we'll start to see real RIA flow. Like right now, what we're seeing is very limited in the US. I think we'll start to see that towards the end of the year, maybe early next year, Q4, Q1. And then I think you'll start to see those positions grow over the next 2 to 3 years as they actually build towards more material allocations. I don't think people are going to jump in even with 1 to 2%. From what I've seen, I see people jump in with 5 basis points, 10 basis points, and build in our experience.
Yeah, look, I'll just add, the state pension funds in the US, if you look at what they are actually allocating, it's around that percent. It's around that percent mark. Now, the pension funds that are leading are traditionally those riskier pension funds, or the ones that are innovative. We saw this in the early 2000s with the hedge funds. It's the same players moving first into investing into this asset class. That's going to give other state pension funds the cover to say, look, if SWIB, as an example, is buying this product, we've got cover, we can look at it as well. We can start running this through our portfolio construction and allocate 1%. So it's step by step, catch a monkey, keep going, catch a monkey. So to answer your second question, I mean, look, what have we effectively done? We've taken a decentralized asset class, put it into a regulated security that's traded on a regulated exchange that gives you 13F filing transparency of who the holders are. These institutions need this product. They need this for validation. They're not now going to start saying, let's open up our own wallets and start trading. They need the cover that our ETFs are giving them.
Well, go ahead.
And it's not sexy, but a lot of that's an infrastructure question. Tax reporting, reporting for clients, compliance. People don't have that infrastructure built, and it's not worth building for a 1% to 2% allocation because it doesn't fit with anything you're already doing. The reports that they generate for their investors in the pension plan are standardized. They're produced by software. That software doesn't consume information about crypto. The compliance software that checks that what traders are actually trading and that those trades have been cleared doesn't have crypto in it. The risk management for that doesn't have crypto in it. Doesn't even have the connectivity to get the data. And that might change over time, but the bar required to justify building that in terms of the size of position you need is very high. And a lot of those systems are actually in-house built. They're not out of the box or they're heavily customized. And so it doesn't make a ton of sense at an infrastructure level. They're not going to sit here and start fussing with custody and other things. It's the same thing you see with gold. Like RIAs don't really buy gold bars for their clients. They buy gold ETFs for their clients. There's a reason for that. And I think Bitcoin's going to follow a similar model.
Yeah. My first book was on ETFs, and the last advantage, I wrote the advantages, was convenience. I'm telling you, never underestimate the power of convenience in a business. You click one button and you just outsource all that to them. Now, this brings up the ethos of Bitcoin, decentralization. You've got these big firms coming in and saying, we'll do all that for you. And now they're outsourcing it. They're putting it, a lot of them are on Coinbase. What about that tension between the original, hey, Bitcoin is supposed to be money that's off the system, and yet here we are, it's being sucked in to the system, or at least these big players. Do you think about that tension at all, and how do you sort of come to grips with it, especially when you're dealing with the crypto crowd, not the advisors?
Yeah, I think there's two things there. The first is that everyone in this room understands the utility of Bitcoin, the ability to hold your own money and send it to anyone without asking permission. That utility is not particularly valuable as a New Yorker with multiple bank accounts and multiple credit cards. I don't really need the utility, but I can very much appreciate those who live in emerging markets or frontier markets or under totalitarian regimes who do need that utility. So the ETFs allow institutional investors to access the speculative properties of Bitcoin, even if they don't necessarily need the utility. The second point is that when you're managing OPM, other people's money, you can't hold the shares of stock yourself. You have to let a third party hold them, and the same goes for Bitcoin. So the way that you get a third party to hold it is through the ETF wrapper. It creates that separation of powers, checks and balances that modern financial systems require.
So I actually, to some extent, disagree with the premise of the question. I think that...
That's okay. We're friends.
Yeah.
I'll get over it.
So I think, yes, Bitcoin has utility as a payments network to some extent. I think a large part of what people today are thinking about Bitcoin as is more in a monetary policy context and less in a payments infrastructure context. That both has to do with the amount of time it takes to process transactions, the cost of Bitcoin is not Visa Network. It's also not trying to be Visa Network. There are other things that are trying to be Visa Network, and that's fine. Bitcoin is really intended to be a form of currency, right? This is about hedge against inflation. This is about M2 monetary supply. This is about, having a direct relationship with a bearer asset that's not controlled by a government and not controlled by a politically influenced monetary policy. That's a lot of the narrative around Bitcoin today. And so I think if you are a crypto native, and I certainly am, I have coins that I hold self-custody, coins that I hold on exchanges, and ETFs, and they serve very different roles. And there are different assets that I'm more likely to buy in one way versus another, depending on what it is I'm trying to do with it. And I think there's a nuance to that. But there are a lot of people for whom, look, my mom loves crypto. My mom's the person who introduced me to crypto in 2013. She totally gets it. Has absolutely no interest in ever owning a ledger. That is just not something she's going to do, and she's perfectly happy to pay somebody to process her wire transfers. That is how she likes to run her financial life. That is how most people will run their financial lives. I think but that doesn't mean they shouldn't be included in a new system. And there's a difference there. And so the question is Bitcoin really about being able to directly transact? Or is it actually about having more transparency, more control over monetary supply, more control over money, less government intervention in those assets, less power within banks, but still wanting to include 7 billion people? Because 7 billion people are not going to sit here and process their own wire transfers. And I think that's actually more the natural tension to me versus that centralization component.
I agree. And one guy put it as a Second Amendment of money, right? It protects you from the government debasement. And even other countries in the emerging markets, it's really bad. U.S. is pretty bad. Like the dollar is devalued a lot. It's a fact. That's a great case for Bitcoin. But some people, when they go down that mindset, they start to go further and they look at FDR confiscated all the gold. So then that leads you to the place where I need to put my Bitcoin, bury it in the yard with my code and stuff.
And there are people who also bury gold bars in their backyards, and I know people who keep a lot of cash, as in literal paper money, in safes at home because they have concerns about bank stability. So yes, and by the way, if you feel that way, you should totally do that. That is, however, not most people. And I think the question is, just because you don't believe in that, does that mean that you don't have a stake in Bitcoin as a network? Or, by the way, a stake in Ethereum as a network, or any of these other assets? And I think that's the real question, is saying, well, wait a second. If what you're actually trying to do is build a new monetary system that actually works like a reserve currency for the world, you need a couple billion people to participate in this. If not, it's not going to work. And you need to provide that in an accessible wrapper.
And that leads on to, look at what's happened overnight. Okay, overnight, you now have large global institutional asset managers adding liquidity into this ecosystem. Now, we're humbled to be in a room with such brilliant minds. Everyone wants to get to Web3 island. We're currently on Web2. You're not going to get to Web3 without using the existing rails, without leveraging the existing ecosystem. Only through doing that can you then get to that sort of place. So the fact that you now have large institutional asset managers having their own wallets, their own keys, transacting in the underlying and putting it on chain, I mean, that's just opened things up completely. So you're not going to get there without bringing us along, and we're going to help you get there.
All right, let's move to Ethereum. These ETFs are going to come out probably in a month, we'll say, give or take a couple weeks. What's going to happen? In the US, they don't allow staking, right? That's one hurdle. Because you could argue you could get 3-4% more if you did it directly. Then the other is what I said earlier. Does the boomer really need more crypto hot sauce? Doesn't Bitcoin sort of satisfy that portion? And can an advisor even explain Ether to somebody like that? A lot of questions in there, but go ahead, take whatever one you want.
So one thing I will say is, obviously, we have a live filing in with the SEC on ETH. So I'm limited with what I can talk about. But one thing I can point to in our 19.4b filing is the fact that we're not staking. Okay? So regs have somewhat completely changed the structure of this possibility. But what has it made it look like? Well, these are going into 33 Act commodity funds. So in all intents and purposes, Bitcoin and ETH, from an ETF point of view, are exactly the same. Yeah? Of course, there's an underlying business case. You can equate ETH to a stock. You can do a valuation. We have a digital asset team. We have analysts that sit there and say $3,600, overvalued, undervalued. Where is Ethereum going? They then look at all the potential upside and they calculate a fair value model. So you can go to an advisor. You can tell an advisor that something along the lines of, look, 30 years ago, if I introduced the HTTP protocol to you, and I said there's an economic incentive for you to get involved in this, in about 25 years, there's going to be north of $10 trillion of market cap sat on that protocol. And guess what? You can own a piece of that. That's the kind of story we're telling now. And that's the kind of pitch we're making for ETH.
That's pretty good. I won't lie.
I think long term, the market for Ethereum ETFs could be bigger than Bitcoin, just from the simple view that the market for productive assets is a lot bigger than the market for gold. The lack of staking will definitely hurt that demand in the US. So we also have a VanEck Ethereum ETP in Europe, which recently introduced staking. We're up to about 70% staked on that product. And so offering a product that has 0 is going to be, less interesting. My guess is that the staking limitations will not be permanent, that over the next year or two, we will be able to add that feature, and there's going to be lots of investors like the hedge funds who bought $5 billion worth of Bitcoin ETFs that are going to look to front run that type of development. And that's one thing where I think TradFi is going to like Ethereum because it's a tech play, it's an open source app store, and there's a product cycle story. Ethereum doesn't stand still. You can look at what's going to happen in 6 months, what's going to change in a year, and tech investors like to buy product cycles. So I think that's going to be helpful for driving continual demand.
So we've been running, we actually run the largest Ethereum ETP in Europe today is a 21 shares product. And we brought staking online in that product basically as soon as Ethereum transitioned to proof of stake. The feedback on that's actually been really interesting because it's more mixed than you would think. You would think that everybody wants staking. It's yield, that's great, that's exciting. The answer to that is sometimes. And I'm curious to see how this plays out in the US market because retail really likes staking. Large institutions have much bigger problems with staking because one of the issues here, and it's sort of something we've had to contend with over the years, is that there is the unbonding period for ETH is dynamic and long relative to a T0, like a T0 or a T1 settlement cycle for the underlying assets of an ETF, which essentially means, and the way we've dealt with that is we built some pretty sophisticated models that essentially manage how much is staked at any point in time based on how that period is shifting and what market conditions look like to try to ensure there's always liquidity within this while getting as high an amount staked as possible, right? So there's like a trade-off between risk and return here. The issue is for a lot of institutions, that's a little scarier. And their feedback on that is, well, like, wait, how does liquidity really work here? What's going to happen if there's a liquidity crunch? How do you deal with that within the context of the ETF? And so we've actually, we also have an unstaked version because there are certain types of clients that actually really want that. And so I think it's going to be very interesting to see in the US how that plays out and whether or not you actually do end up with 2 versions or 1. Because there are certain types of institutions who are happy to take the hit on the return in order to guarantee the liquidity. And I think that risk decision hasn't happened yet. And given that the level of sophistication in institutional investor circles with regards to actually understanding how Ethereum and how staking in particular work, and that's not like the hedge funds that are actively trading or people who are very engaged in the space, but going back to that RIA in Kansas, I would not be surprised if actually an unstaked version is initially significantly more palatable and significantly easier for them to get through their risk committees to actually approve product. And that's going to be a major determinant of how distribution works. So in an interesting way, I think this decision, while probably unpopular with retail, will end up being helpful in terms of setting up institutional distribution initially. I think it'll change over time, but in the early innings, I think it's not necessarily a bad thing.
The only other thing I'd add is, look, in the TradFi world, you're going to meet loads of individuals who behind the scenes have been investing in Bitcoin for years. Yeah, we've all believed in it, okay? Now, you need those TradFi individuals. There's analysts at desks now doing all these valuations, crunching all these numbers. So now they're going to see this business case for Ethereum, and they're going to say, let me add that to my 60-40 portfolio. Let me do some optimization. Let me see where that comes out. And I think the staking aside, you look at any investment and you say, you've got this reserve currency, you've got the US dollar, you've now got a dominant infrastructure play into this new world. It's quite possible that institutions are just happy to have that dominant infrastructure play, and that's the exposure they want from the infrastructure space. What potentially comes next is the consumer-driven protocols or the whatever else comes after that. That's when they'll look at other things. So we predict, or we think it may actually, we will see a pause now, and these two products will be there in the space to give institutional investors the exposures, the applicable exposures they want, and for the time being, that could be enough.
All right, well, we will see soon. Last topic, last question. I was recently in Amsterdam at an event there at the stock exchange on tokenization, and multiple people said tokens are going to overtake ETFs, including someone from your own team. I'm going to give you my pushback, and then I'll let all you guys take a shot at it. If you're sitting there at your desk and you want exposure to the S&P 500 or the Euro stocks or an Australian index or junk bonds or Bitcoin, you literally click buy. 1 second, you own that. Now, it takes a day, and there's some stuff that goes on behind the scenes, but that's it. It's zero friction. The ETFs are all dirt cheap, tax efficient. What is this a problem in search of a solution? Because to me, that just seems like utopia right there. And if something goes wrong with the ETF, you can call somebody. Who are you going to call with a token? If it's all off the grid, like who do you call? So I'm not sold, even if some of you guys are, that tokenization will overtake ETFs, because ETFs have just arrived, and they are disruption machines.
So I don't think it's a question of replacement. ETFs are a wrapper, and they're a legal structure. Very few people spend any time whatsoever thinking about what happens on the back end of an ETF. Back ends of ETFs are affectionately referred to as Frankenstein instruments. There are dozens of people doing all sorts of things. They're emailing each other spreadsheets. They are, reconciling data every day from disparate sources. There are mistakes. Because there are mistakes, people are running multiple versions of that data in different systems and then cross-checking them. It's actually how these things work on the back end. And you've got generally 10 to 12 completely siloed entities that somehow have to all both receive this information and agree it's correct before they do anything with it. The interesting piece here is that you could theoretically, and this is actually the way I think about tokenization, is it's actually an infrastructure play. And it solves two problems. One is it's really expensive to have 12 different entities doing this and dozens of people doing this. It would be far better to have a smart contract doing it, which doesn't cost anything, which ultimately will put more money back in the pockets of investors and, by the way, create more certainty with market makers in the data that they are receiving, because they can actually see how it's calculated, which should bring down spreads and increase their confidence in the data that they're receiving and they're ultimately trading on. So the question is, what is the actual difference between, on a long-term basis, a token and an ETF? Probably nothing. You probably end up running ETFs as tokens. It's an infrastructure discussion, not a change in either the user interface or even necessarily the issuers that are actually creating these products. And it'll open space for new issuers and new infrastructure providers and new players in this market. I think it will be disruptive to the market, but I don't think it will actually be disruptive to consumers who currently have access to those types of things. And by the way, including fractional trading. You can fractionally trade on most retail advisor platforms today. But the way in which you do that and the cost to you of doing that and the cost to the provider of providing that service, that's where you can actually change something and actually end up with more money in consumers' pockets and less being spent on invisible infrastructure that people appreciate the benefits of but don't intrinsically value. And I think that's actually more the direction of travel, coupled with an ability to actually distribute these products and address a much wider audience. And I think when you talk about tokenization and ETFs, I think that's really where you're going. And there are obviously other pieces, right? There are CBDCs, there are, the tokenization of illiquid assets, there's the tokenization of data and identity and increased ownership. But where that actually intersects with ETFs, I don't think you have to kill ETFs to create this. I think you improve upon the operations and you improve upon the actual structure of the wrapper. That's a very different discussion.
The irony is, right, within the TradFi world, we are considered disruptors. Okay, we are considered disruptors because we have disrupted the mutual fund. Yeah, I work at a 76-year-old asset manager that has sold mutual funds for 76 years. We came into this firm 7 years ago to build an ETF franchise. We've successfully done that. Now, with that disruption, obviously we're sat in our seats thinking, what's going to disrupt us? What's coming down the line? And of course, we believe that tokenization, as you said, the infrastructure play, it's a pure infrastructure play. What have we done? We have tokenized, we were the first to tokenize a US government money market fund. The simplest financial instrument you can find, okay? If you go and buy a money market fund today, you can trade it once a day, okay? if you want to go and get a yield from your fund, you have to hold that fund at that particular time. If you want to sell it, if you're an institution, you get your cash in your bank 24 hours later. If you're an individual like me, it'll take you 72 hours, T+2, okay? By tokenizing this money market fund, we can give you instantaneous trading, stuff you all know. We can give you, if you hold the fund for 10 minutes, we can give you 10 minutes worth of yield, and you can transact and sell it whenever you want. I mean, the efficiencies there for the consumer is obvious. Now let's talk about the efficiencies for the fact that it's taken our costs all the way down. And for those that heard Jenny before, we can now offer those products not at a $500 ticket entry, but at a $20 ticket entry. So we can go after a whole new generation of savers in their early years that can now start allocating. And this is transformational for asset management.
Before you go, Matt, I will say that is a mutual fund. So the once a day, I get
you can do.
They're disruptible.
Of course.
Harder to do with an ETF.
Yeah, but the components of the ETF that we still can't do is I can't give you 10 minutes worth of yield. Yeah? Based on you holding.
You're right. Okay. Go ahead, Matt.
I mostly agree with you that a tokenized money market fund is not very interesting, not terribly differentiated. The opportunity cost when you can buy Bitcoin with that, instead the profit margins that you're earning on a tokenized money market fund are very, very low. So we've done a lot of R&D and brought zero to market intentionally. I think what might evolve down the road is that you'll be able to program some instructions at the user level into like when you might rebalance, and that'll be easier to do with smart contracts than with your E-Trade brokerage account.
Like, for example, what we've done is we've successfully put all of the fund operations of an ETF into a smart contract. That changes things. Running a PCF is not interesting and expensive. You can do that with a smart contract. And the people who currently do things like fund accounting and PCFs charge on the low end 4 basis points and on the high end closer to 10 to actually operate these products. That's where you can actually change things. If you can replace 2 of those basis points with a smart contract, that's money you can actually give back to your clients.
I'll just add that tokenization of the money market fund is our first step. Now, imagine, we've been in the industry where 20 or 15 years ago, if you wanted to get exposure to gold, you had to actually physically buy gold bars. The ETP changed that. You can now buy gold on an exchange and buy it and sell it when you want. The ETF disrupted that space. The same thing's going to happen in the private market space. All of a sudden now, real-world assets, you all appreciate this. You can tokenize real-world assets. You can now fractionally own them. Now, the delivery vehicle to then give those to institutional investors, guess what? It's going to have to be the ETF. So we do see a path for more ETFization, if you like, of this complete space.
So, have we convinced you?
Henry and I can keep our titles as ETF analysts. We don't need to change them to token analysts, at least not soon. Okay, I'm trying to be aware. I don't want to miss the boat. All right, look, we got 1 minute left. Lightning round. You saw my chart. There's $60 billion in spot Bitcoin ETFs. You could add another like 3 for the futures. We'll call that the crypto area. And then if you get to Europe, it might get like you to 80 billion, something like that. How big does this ETF of crypto space get, let's say, in the next 5 years? Double, triple? How bullish are you? Quick, in 10 seconds each. Start at the end with you, Jason.
Bullish. I equate it to the sort of hedge fund early 2000s. Wouldn't be able to put a number on it, but yeah, it's here to stay, and I think there's a lot of upside.
I think the 60 billion will 5x due to price appreciation in the next 5 years, and then on top of that, another 100 billion in flows, so like $500 billion plus for crypto ETFs.
Same neighborhood. I think you have almost no intermediated flow yet, which is most of the money in the US market and also most of the money in the European market. There are no pension plans, there are no insurance companies. Like, most of the big money is still outstanding. So I'd be comfortable in that range, maybe even north of that.
Wow. All right, stay tuned. I want to give our panelists a nice round of applause. Thank you, guys. You were great.
All right. There you go.